We have had a massive week of earnings in the stock market, and today we are focusing on AMD, which reported on Tuesday after market close, and we can in fact see over the last month it is down over 17%, and even with that mini crash, we do see Wall Street considering it a very strong buy now, 4.4 rating out of 5. So today we're going to understand why has this company crashed after releasing their earnings, and is it a strong undervalued buy? As always, we'll look at the historical performance, we'll look at their revenue, their top line growth, as well as their bottom line net income. We also want to take a look at the health of the company, their total cash versus their total debt. And as always, it is interesting to see not just what insiders are doing in terms of buys and sells, but also institutional ownership. We'll also look towards their investor presentation, a few slide decks, so we can understand what the future is looking like for this company and their growth. And as always, we will dive into their underlying metrics, free cash flow, their ROIC, sales growth, their debt levels, and end it with the valuation model, getting to our intrinsic value, our acceptable buy price, given that investor margin of safety, and also understand how much growth Wall Street sees over the next view of their earnings. We can see, and the headline does read, that they will sell $4 billion in terms of AI chips this year. However, one of the main reasons for the stock drop was due to the fact their forecast was just in line. The market was anticipating this to be guided higher. Now, in terms of actually how did they report in terms of the targets, well, earnings per share was a marginal beat, 62 cents adjusted versus essentially 61 what the market was anticipating. And on a revenue, they also beat 5.47 billion, again very marginal beat on the top line as well as the earnings per share. In terms of their bottom line net income, well, we can see 123 million. However, when we compare it to the same quarter from the last year, they in fact did make a loss of 139 million. So very positive to note, in fact, that they now reported a net income for Q1 of 2024, whereas Q1 of 2023, in fact, it was a net loss. We also note their top line revenue was up 2% from the same quarter last year, but we are going to do a deeper dive into this later on in the episode. So let's look at the historical performance. Now, granted, they are down around 18% over the last 30 days. When we look at the performance year to date, they are pretty much flat, down 0.85%. When we extend it over the last year, however, they are up still very strong, 63%, even after the dip over the last 30 days. And when we extend it over the last 10 years, we can see this is up over 3,658%. We can also see with the current price of $148, they are somewhere away from the 52-week high that we saw not too long ago at $227. So let's take a quick look at the numbers, remind ourselves of the strength of this company. On the top line, what we want to analyze is at least 3 to 7% mature companies. However, AMD, this is an AI company, so we would expect a much larger increase. 5.5 billion reported in December 2014. 23 or just under 23 billion in the more recent annual report. So we can see more than 4 times growth over the last 10 years. And when we look at it on a graph basis, we can see over the more recent years some very rapid growth. So it will be interesting to see their forward guidance later if this is something they do expect to continue. Now, on the bottom line, net income, we actually note they did report a net loss for around 4 of the last 10 years. But since then, we note it's gone from 403 million net loss reported in 2014 to 854 net income in 2023. But one thing that we do note from this is the inconsistencies over the last 10 years. Even over the last 4 years with an increasing top line, we would have expected their bottom line to also follow a similar format. So just something that we should take forwards into our own investment thesis, a little bit of inconsistency. When we take a look at the health of the company, total cash and short-term investments versus total debt, it has increased from around 1 billion to just over 6 billion in their latest report. So they do hold quite a fair amount of cash, and as we can see, it has been increasing over the longer term. Now, important to understand how that compares to their total debt numerically and directionally. And what we can see here is, in fact, their total debt, while it has increased, it is very marginal, from 2.2 billion to just under 3 billion. And what we notice from anticipating their cash balance, we can see that their cash is a lot higher than their total debt. Therefore, when we do come to that net debt to EBITDA metric, there are no real worries with the balance sheet, and we can also see a lot of inconsistency with these numbers. Now, one thing that we quite like to look at is very briefly is their earnings and how they have performed. When we take a look at the last 4 quarters, what we can in fact see, 3 of them they have in fact beaten, and with the third one, we do note Q4 of 2023, it was at least in line. So that is a fairly strong performance. 3 out of 4 beats, and the one that didn't was in line. Every single quarter over the next year, we do anticipate they will beat year on year by strong double digits as well. So that is a positive sign, not just that they are beating their earnings estimates, but also the anticipation moving forwards, there will also be a large increase, as we can see here on the year on year. Now, when we analyze their valuation, very important to understand, a lot of these AI companies are trading very high on a PE basis. We do in fact note they get a D- grade. Very quickly then, on a non-GAAP basis, forward-looking 41.55. The sector median is around 23.04. And then when we take a look on a GAAP basis, it is a lot higher, 95 versus 28. Now, the one thing that we would say here is a lot of companies that do trade at a very high PE tend to have some justification for why this is. They may have a very strong backlog. They may anticipate that the next few quarters they are going to increase very, very rapidly. But this is something we will look at when we take a look at their investor presentation and their forward guidance. Growth grade, well, an A-, so not too bad. Let's find out why and what this is made up of. Firstly, their year-on-year revenue growth down 1%, sector median over 3.4%. Not the greatest, but on a forward basis, strong double digit versus sector median of just under 7%. We can see the year-on-year EBIT growth very, very strong, triple digit, with the sector median -2%. And we can see a very similar format throughout all these different measurements of their essential growth. The one thing that I do quite take a look at is their earnings per share on a forward basis over the next 5 years. They are anticipating it to grow strong double digit, 42%, versus the sector median at just under 14%. So we can understand why it isn't essentially always strange at why companies trade at very high multiples. There are reasons for it, and one of the reasons we can see here is their earnings per share is expected to increase very, very rapidly over the 3 to 5 year period. How about their profitability? Well, a B+ grade, just 2 metrics I like to really point out from this. Firstly, their gross profit margin, 50.6%, slightly higher than the industry leaders and the median point of 48.55. We can also see the bottom line, 4.9%, again marginally better than 2.41%. But we do want to also point out in today's episode that their cash from operations, this however is on a trailing 12-month basis, 1.7 billion, with others in the sector at just under 88 million. So as always, with this information, take it into your investment thesis and then decide whether or not you do consider this to be a very strong option for your portfolio. Now, in terms of past performance, we have Qualcomm, Texas Instruments, Intel, quite a few of these we have recently covered on the channel. Over the last year, in fact, AMD is up 65.6%, one of the best, in fact, the second best, just lagging behind Micron Technology, ticker symbol MU. When we expand it over the last 5 years, we can see they are the best performing, up 426. Over the last 10 years, there is no one that comes close in this industry, as we can see here, 300, or in fact 3,747%. Although when we do incorporate Nvidia into this, they are outperforming AMD. So as always, yes, incredibly strong, but do understand past performance is an indicator. It doesn't mean over the next 10 years they are going to do another 3,000%, but it also means that they might also do that. So again, something just to bear in mind. Insider ownership, it sits at 0.73%. We note 8 instances of insider selling, 123 million over the last 12 months. And in fact, over the last few quarters, we see a lot of insider selling, 2023 as well as 2024. Let's take a look at who these people were. So in fact, we can see the more recent one was Mark P, the EVP, 15th of April, selling over 16,000 shares for a price which, as we can see, is marginally higher than the current trading price, for a total of 2.66 million. We also have essentially another insider sell by him by pretty much the exact same number of shares, and we do note 15th of March, and that price was also trading higher. Whether or not you want to include it into your own investment thesis, again, for me, this is something that we don't know the reasons why. It could be personal or financial reasons. However, for transparency, we can see here that, in fact, he has sold twice, and in total, just over $5.6 million. Now, when we look at institutional ownership, 71%, we note 11.65 billion worth of sales over the last 12 months. However, a lot more buys over the same period as well. The majority of this we can note in quarter 2 of 2023. Looking in the more recent quarter though, we do see essentially double the amount of sales of 1.6 billion versus 836 million. And as we did talk towards the beginning of the episode when looking at their earnings, the market didn't like the fact that they hadn't raised their guidance for the full year of 2024 as one of the reasons for that stock drop. Hence why we do see here institutions have been selling a lot more in the more recent quarter. But over the last 12 months, as we note here, more buying than selling. Now, before we do jump into these metrics, we just want to let you know that we have dropped our latest free weekly article. If you want to gain access to this or any others, click on the pinned comment below. You can start reading straight away. Now, this article here, how to find undervalued dividend stocks. Every single episode, we have people asking what are the websites we use. It is all explained in here, so you can go ahead and use them as well. Now, in terms of their latest presentation, literally just dropped a few days ago, there are some things we just want to point out. First one being, when we do look at their revenue, comparing it to the same quarter in 2023, we do note there is an increase, although very marginal at 2% year on year. So again, a lot of people in the market, similar to Nvidia, who did blow out their earnings very strongly, they were anticipating a very similar scenario with AMD. So in fact, we will cover Nvidia earnings, so it will be interesting to see whether or not we see a very marginal increase in this comparison. When we take a look at their gross margin, as always, we want to see increase to their top line revenue. We also want to see an increase to their margins. And what we note here is on a GAAP basis, they have increased from 44 to 47%. We also note, for those that also like to look on a non-GAAP basis, the increase is very similar as well, 50% to 52%. So a positive sign in my opinion when you have companies that increase revenue as well as their margins. In terms of operating income, we also note operating loss. We did take a look at this earlier. They were loss-making for quite some time. However, over the more recent years, they did turn that around. Well, in Q1 of 2023, they did make an operating income loss in terms of a GAAP basis. However, in Q1 2024, it was positive, and the same we can see on a non-GAAP basis, much better in Q1, 1.13 billion versus Q1 2023. Then we look at the earnings per share. Again, a very similar scenario. Not going to talk too much, but just to point out that they have performed better in Q1 24 versus the same quarter last year. The other thing we really wanted to draw out from all of this is that their growth in their revenue as well as their margins is coming from the data center element, very similar to Nvidia. We can see here their revenue is up 80% year on year, very, very strong. Data center is an area that we expect essentially to increase over the next few years, not just for the likes of AMD, but also the likes of Nvidia. And we can see their margins have been very strongly increased from the same quarter, 11% to 23% in 2024. In terms of a quick summary, while their revenue then for the quarter was up 2% year on year, their data center segment up 80% year on year, their margins looking very strong and healthy, as well as their earnings per share beating what market were anticipating, as well as from the same quarter in 2023. Finally, we do want to take a quick look at the outlook for the next quarter. They are anticipating 5.7 billion on the top line, as well as a diluted share count of around $1.64 billion. Now, in terms of the metrics, always important to understand, we do like to focus on the free cash flow. Always try and invest in companies that are increasing free cash flow year on year. We do know it went through a period where, in fact, it was negative. From 2019 onwards, it has started to increase. But you could argue the cyclicality here since it did peak in 2021 before coming down. However, 2024, we are expecting some very strong growth to their free cash flow. In terms of sales then, again, we want to see double digit, ideally for these companies that are growing at a very fast rate. We do note a very strong period from 2020 to 2022, although the last full year we did note a drop of -4%, and we can see numerically just another format to what we looked at earlier. Now, shares outstanding, two things to note. Firstly, we love it when companies do share buybacks, effectively giving us excess cash. However, what they've done is diluted share count by essentially increasing it over the longer term. The only thing to point out realistically here is that if you are getting over 3,000% return over a 10-year period, you wouldn't really care if they were diluting yourselves. But again, just want to point this out. ROIC, as always, one of my 7 golden dividend metrics. You want to see a minimum of 10% just to give you faith that management are able to effectively allocate their capital. It is fairly mixed, so again, just something to incorporate and maybe factor into your own margin of safety. In terms of margins, well, we want to see 16% as a minimum. Now, we can see they have had some tough times over the last 2 years. Ideally, with their growth in the data centers, as we did see, and the increasing margins in that, hopefully this is something that will start to go back up to the levels we saw in 2020 and 2021. Free cash flow margin, minimum of 5% is what we want to see. They have essentially been getting that over the more recent period. Just something to keep an eye on, ensure they can continue with. Now, finally, the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. As always, this gives us balance sheet strength, and we want to see 0, which is what we see here, meaning it wouldn't even take them 1 day to pay off all of their debt net of cash on hand. A very strong balance sheet, so no worries whatsoever with this company with respect to that. So let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now we're going to move on to the only model that we do believe is a fair valuation of AMD. It is the discounted cash flow model. Now we can see the growth over the longer term. We do note a drop into 2023. So for 2024, they are expecting back to the levels seen previously, hence why we have started that off in 2024. Now, forward looking, you can go with different rates. We've gone with around 25%. Bear in mind, with that discount rate, it gives us the present value of future free cash flows and terminal value. Add the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get to the intrinsic value. So we get a sign of overvaluation. Now, bear in mind, this is on a growth rate of 25%, which we would say is a medium target. If you believe that, in fact, it should be lower at 20%, this will then give you essentially an intrinsic value of $106. Now, that is an implied upside, or in fact, as we can see, downside of negative 28%, whilst essentially the medium at 25% was downside of negative 4%. Now, people could say, you know what, those are unrealistic. This company should be much higher. At a 30%, we can see it would be a buy undervaluation at $190. Giving essentially upside of 28%. Now we're going to take through the 25% to the final slide, but just to let you know, you can grab a copy of this model so you can play around with the numbers. You can also put other companies in here, whether that's those on your watch list or in your portfolio, and you also gain access to the other 3 models shown on screen. So now what we do, we have an intrinsic value of $142, and as we can see, it is slightly higher than the current price. So right now, this is trading at a premium in our opinion. What we would typically do is start off with a margin of safety. We'd use 10% as our MOS level and execute only if it met the 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. And then if you didn't believe that and you think it should be higher, we'd keep going until we believe it be around our acceptable margin of safety. But in today's episode, we can see for a 20% MOS level, it would be a buy around 114. However, right now, there is no margin of safety. Interestingly though, with Wall Street, they do anticipate this to have upside of 31%. As we saw earlier, they do believe this is a strong buy now with a price target of $194. As always though, do let us know your thoughts in the comments below. Is this one you're looking to buy, maybe looking to sell, or in fact it is purely on your watch list to see if it will come down lower? For me, whilst it does look like a very strong company to add in this industry, it is trading a little bit too high with no margin of safety. And as of this moment, I would rather invest in a semiconductor ETF than in a company like AMD, which as we saw has no MOS currently. As always, let me know your thoughts below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button. And as always, we'll see you all on the next one.